The War of 1812 is where the federal government started to really build its debt issue. In 1812, the federal government had a debt due to the War of 1812 of $45.2 million. Now, in today's terms, that would be roughly a trillion, a little bit over $1 trillion. But what the government did to solve the debt problem is they started selling property, selling land for $2 per acre to settlers. Now, these settlers were buying land that was owned by the Indian. It was Indian land. It was kind of a ripoff for the Indians. And in fact, this book, Raw Deal, talks greatly about how the Indians owned the land, or they had the land, and we pretty much confiscated it for the settlers. And you had David Crockett, you had Andrew Jackson, Daniel Boone, William Clark, Meriwether Lewis. They were all pretty much moving to the west and taking land from the Indians, and that's what they used to pay the federal debt. Now, today, the national debt is approaching $40 trillion, of which just the interest payments alone are $1.36 trillion. So I've kind of thought about, well, in the past they sold the land to the settlers to pay the national debt. What if we wanted to sell all the gold at Fort Knox? But that would be only $653 billion. The interest alone on the debt right now is $1.36 trillion. So the problem here is that interest rates are becoming a very serious issue and causing the market to have what we call a whack-a-mole market, where we get rallies knocked back down again. Now, this is all because I believe interest rates are climbing. The 30-year Treasury yield just hit a 19-year high. And if you look at history, you can see what the 30-year Treasury bond has done since 1942. Now, with interest rates, what you want to pay attention to is not the level of interest rates, but the trend of the rate. So here's the 30-year bond. You can see since the beginning of the decade, interest rates on the 30-year bond have done nothing but decline. Made a major low back here in 2020 and started to move up. So we are seeing rising interest rates. Now on our power index, for the last 125 days, the yield on the 5-year Treasury note has climbed to 19.36%. So this is causing problems for the market. However, the primary trend for the S&P continues to stay positive, as well as the NASDAQ. Somehow the market is continuing to deal with this issue. Now, if we realize that we are in this whack-a-mole market, you can see here with NVIDIA, we rallied to a high in May, and like a whack-a-mole, knocked us back down, rallied, knocked us back down, rallied, knocked us back down, and is rallying again. So the market is having serious problems right now due to the fact that interest rates are climbing. Now, just to kind of take a snapshot of what's going on, this is the QQQs, which represents the NASDAQ. You can see here we've had somewhat of a break in the price in the index, not seeing much improvement today, and we are seeing above average volume on that breakdown. On the S&P, by the SPY ETF, you can see here again we've gotten a pullback, somewhat more stable than the NASDAQ, and volume has been somewhat subdued. We are pretty much in the summer doldrums here. Now, if we look at the aggression index, you can see here we've broken down here to the moving averages. This is where the growth stocks compared to the consumer staples are showing some weakness in here. Now, some stocks of interest that I currently own. We own Palantir Technology, which is an interesting software company. In fact, they're being called the operating system, the operating software for AI. But you can see here, this stock is holding up relatively well. We've got the breakout here on very heavy volume on around August the 2nd. Major breakout, holding that breakout and looking somewhat positive. So I would keep an eye on Palantir. Another stock to keep an eye on, and we're seeing strength in the healthcare stocks. This is glucose, which has to do with glaucoma. And you can see the stock has been holding up fairly well, in fact, almost breaking out to a new high. So the tech stocks are starting to show weakness. However, we're seeing some strength in things like healthcare. Airbnb, this is a stock involved in travel and tourism. We're talking about a $108 billion company. You got the breakout on earnings, consolidation, and starting to break out again. So I would definitely keep an eye on Airbnb. So all said and done, we're seeing a lot of rotation here into things other than technology. So just keep an eye on the market and let me know if you have any questions. Thank you very much.